Hello friends, how are you? I hope all of you are doing really good. So welcome to Economics of Finance Excellency batch. Okay, so what we have been discussing about, we are going to start with our new chapter, that is chapter number 6, Fiscal Policy. So it is in continuation with the last three chapters. We studied about the fiscal functions, then we studied about the market failures, we studied about the government intervention to correct the market failures. And now in this chapter, we are going to discuss about the fiscal policies, means the policies being developed by the government. Okay, let's try to understand first what is a fiscal policy, right? We need to understand only the basics first so that we can proceed on. So policy, you all know what does it mean by a policy. That is some planning, or you are making a policy relating to how many chapters you have to do. That is a policy, right, where the action is required on that particular planning. You call it as policy. Now what is a fiscal? Now, what do you mean by fiscal? If we talk about fiscal word here, this fiscal means the money part, right? Now we say if you want to run an economy, what do you need? Obviously, sir, you need money, right? But the question here is how to arrange this money. How this money should be arranged. Sir, if you want to do any transaction in an economy, you want to buy goods, that is an economic transaction, isn't it? For that, what you need money, isn't it? For running any kind of an economy, any kind of an economic transaction, if you want to do, what you need money. But where does that money come from? And whose responsibility it is? Sir, it is the responsibility of the government to arrange the money for the economic transaction or for the smooth functioning of the economy, right? But the problem here is how the government is going to arrange that money. That is again a big question. Or how the government, see, what is the basic role of government here? What is the basic role of government? The basic role of government is economic welfare, right? Economic welfare. So fiscal policy says that the government need to create such policies related to money which lead to economic welfare, right? Why there is a need for these kind of things related to money? Why there is a need for such policies related to money? How are those policies being executed? How are those policies being executed? Just try to understand why there is a need for a fiscal policy, or why there is a need for any policy which is related to money. Let's say what will happen, sir, if the people in the economy have excess money in hand, if the people have excess disposable income, if the people have lots and lots of money in hand, what they will do is they will obviously spend this money. Obviously, sir, they have money, they will spend this money. Now, when they will be spending the money, what will be the consequence of that? It will lead to the higher prices of the product. Higher prices, because the seller knows that the person is having the money, so he will say I can charge anything, and the person is ready to pay for that money. So why not charge anything and increase the prices of the product? Because that's the person who is in front of that seller, he is a rich person, he is having lots and lots of money. The seller knows the fact, he will charge higher prices, right? Now when the higher prices are prevailing in the economy, what is this condition known as? This is known as inflation. Sir, these higher prices can be paid by only few who have the money. What about the remaining people who don't have the money, sir? They will get impacted by this inflation part. So now what does the government do? Government creates the policies related to controlling that inflation. Government will say, those who are having the excess disposable income, they will be charged higher taxes. The government say pay higher taxes, right? What will be the result of this higher taxes? This higher taxes, if you are going to charge a lot of taxes on those people who are already having the excess money, the government says pay us the taxes, right? Why the government is asking for the taxes? Because the government says this will reduce the disposable income, right? This will reduce the disposable income, and the reduction in disposable income means the less expenditure, less of spending, and the less of spending means the lowering of the prices, and the lowering of the prices means the control of inflation. Now when the government is saying that pay us the taxes, right? And the government is planning all these things. This is what is known as fiscal policy, right? Fiscal policy. So any policy which is being framed by the government, right? Why? It is related to money, and why? For the economic welfare of the economy, of the whole economy, of all the people living in the economy. If you want the welfare of those people, the government says we need to create the fiscal policy. So it can be in the form of taxes, right? It can be in the form of expenditure also, the government expenditure. What is government expenditure, sir? How there can be a fiscal policy related to government expenditure? Try to understand that. The government says, let's take an example, a real life example. Let's say you are a student, you need coaching, right? You need CA coaching, right, sir? You have already taken a tax coaching of, let's say, 10,000 rupees. Now you feel that you also need the coaching of accounts, for that is costing you 10,000 rupees, right? That is costing you 10,000 rupees. No, no, sir, you are providing it free of cost on YouTube. Let's take an example, right? So you want, sir, not accounts, I am providing costing, FM and eco. So you want the accounts coaching for 10,000 rupees. But what is your feeling related to this 10,000? You say, I don't want to burden my father with this additional 10,000 rupees. That means you don't have that much of money, right, to spend lavishly, or to spend, without any second thoughts on this 10,000. Buy the coaching. You might, if you have lots and lots of money, then what will happen? You might be buying 2 or 3 teachers classes, right, for the accounts, that whichever suits you, you will go with that. But if you are short on the resources, what will you do? You will think twice. Now you are planning that, okay, I'll try self study, I don't want to burden my father for this additional 10,000 rupees on the accounts. But your father understands your situation. Now even if you are not saying, he will catch the vibe, he will catch the thing that you need some other coaching. Now what is he doing? He puts 10,000 rupees in your pocket and write a note that this 10,000 is for accounts coaching. Now what is this? What is this? You have less of disposable income. Your father is a government, right? The government is doing the expenditure. Why government is doing the expenditure, sir? To increase. Why government is doing the expenditure? To increase the disposable income. To increase disposable income, right? So what will happen? People will have more money to spend. People will have more money to spend, and more money to spend means extremely low prices will be corrected, and this is done during the time of recession. When there is recession, the prices are low, the demand is low, the government puts in the expenditure money so that people have money in hand for the expenditure. Then people will spend money. As people start spending money, there will be more production. The prices, extremely low prices, will now start rising, right? And the economy will come out of the recession. So I have given you an example of inflation also, and I have given you an example of recession also. So again, this expenditure part is what? This is a fiscal policy, right? So any policy by the government related to the money for the economic welfare, that is known as a fiscal policy. It can be in the form of taxes, it can be in the form of expenditure, or it can be in any other form, where what the government is trying to do, the government is playing with the money so that it is equally distributed, right, and leading to the economic welfare, leading to the efficient allocation of the resources. So that is what the main purpose of the government in this whole scenario is, right? So I've just given you an overview of what is a fiscal policy. Now let's read it. He says the fiscal policy involves the use of government spending, that is government expenditure, taxation and borrowing to influence the pattern of economic activity, the level of growth of aggregate demand. Sir, what is borrowing? The government borrows from the people who have excess money. The government says, give us your money, right? We will borrow from you, right? We might pay you interest on that, a little bit of an interest on that, but we will borrow your excess money so that you have less of money to spend. Right? You might earn a little bit of interest on that, but overall you will have less money to spend. Less money means this is done to control the inflation part. So this is why the fiscal policy is created to, to influence the pattern of economic activity, right? This is what is that? Influence the pattern of economic activity. Economic activity is what? You have lots and lots of disposable income to spend. You are spending that money, leading to higher prices. So to change that pattern, the government is creating the fiscal policy. And secondly, the level of growth of aggregate demand, whether you want to increase the demand or whether you want to control the demand, right? For that, the fiscal policies are being created. It includes any design on the part of government to change the price level. The government can change the prices of the product, right? Composition or the timing of the government expenditure. Government can do the expenditure on that, and the burden or the structure of frequency of the tax payment. So government can set, we have already studied about the price ceiling and the price floor. That is what is the price level. Through price level, the government will try to influence the decision making and try to influence the aggregate demand. Right? In case of price ceiling and price floor also, we studied about that how the aggregate demand can fall or the aggregate demand can increase depending upon the prices. So this is what? This is a fiscal policy being created by the government. We have discussed about the taxation. We have discussed about how the expenditure, determines the fiscal policies. So fiscal policy is in the nature of the demand side policy. That means you are trying to correct the market failures, or you are trying to, lead to the allocation of resources, the right allocation of resources through various fiscal policies by controlling the demand, the aggregate demand. Right? And when you are talking about the aggregate demand, that means the focus is on the disposable income. If you are controlling this disposable income, you are indirectly controlling the aggregate demand. If you will increase the disposable income in the hands of people, the aggregate demand will increase. And if you reduce the disposable income in the hands of people, this aggregate demand will come down. So it depends upon the situation. During inflation, what is to be done? During the recession period, what is to be done? Accordingly, the decisions are taken. An economy which is producing at full employment level does not require the government action in the form of fiscal policy. Obviously, sir, at full employment level, what is there? This is efficient allocation of resources. Efficient allocation of resources. That means if the economy is running at full employment level, there is nothing to worry about. Everything is working absolutely fine and there is no government intervention that is required. So there is efficient allocation of resources in this case. Right? So this is about the fiscal policy. He says, what are the objectives of the fiscal policy? The objectives are attainment, achievement, and the maintenance of full employment. This is one of the major objectives, that the economy should reach at the full employment level, because at full employment level, we will say there is proper efficient allocation of resources. There is no misallocation of resources. Then maintenance of price stability. Already you have understood it, that if the prices are going to increase, then also it is going to impact, the consumers, and if the prices go too low, it is going to impact the producers. So stability in the prices is very, very important, which is done through the various fiscal policies. Acceleration of the rate of economic development, obviously for the welfare, equitable distribution of income and wealth, that I have told you, that with the money, why the fiscal policies are created for the money, that there should be equal distribution. Why we are taxing the people? For the equal distribution. Then efficient allocation of resources. If there is full employment, there will automatically be efficient allocation of the various resources in the economy. So all this thing, if I say in the crux, why the fiscal policy is being created? For the economic welfare. Right? All these factors will lead to what? All these factors will lead to economic welfare, sir. Right? So this is what I told you. In short, if I'm saying the fiscal policy is being leading to, the objective is the economic welfare. And in the economic welfare, we can say the maintenance of the full employment, maintenance of price stability, economic development, income distribution, right? Equal distribution of income and wealth, and efficient allocation of resources. In short, in crux, we can say it is economic welfare only. Isn't it? Okay, now the next topic is automatic stabilizers. Now, what is automatic stabilizers? That means whenever there is an instability in the economy, instability means there is either a condition of inflation or there is a condition of recession. There is imbalance between the demand and supply. So there are a few factors which can automatically stabilize the things, right? The direct government intervention might not be required in such cases. These factors will automatically work depending upon the disposable income in hand, right? These factors will automatically work depending upon the disposable income. That is why I say this disposable income part is very, very important in this case. That is why this is known as the demand side policies. Demand side policies, because more the disposable income, more will be the aggregate demand. The people will demand more of the products if they have more income, right? And less of disposable income means the fall in the aggregate demand. So that is why these are known as the demand side fiscal policies. Okay, what are the automatic stabilizers? These are the non-discretionary fiscal policy measures. Non-discretionary means the government is not having the direct discretion in it. The government is not doing the direct planning in it. Clear? They operate automatically, that is, without any deliberate policy actions by the government, but due to the automatic policies which are already existence. There is no deliberate activity or the deliberate action on the part of government that this particular we need to stabilize this particular thing, so this is the action that is required. But there are a few things which automatically work in such a way, and that working is also due to the policies of the government only, but for that there is no deliberate action. Automatically they will move in a circle. We'll study with the help of an example. They are dependent upon the level of aggregate production and the national income. Any government program which automatically reduce the GDP fluctuation is termed as automatic stabilizer. If there are too much fluctuations in the production, right? Why there is a too much variation in the production? When will there be a variation in the production? Sir, if the people are having less money, less disposable income, they will demand less. They will demand less, so manufacturers will produce less, isn't it? And if people are having too much, if people are having too much money in the hand, excess of money in the hand, then what will happen? The people are ready to spend anything to buy the product. There will be excess production in the economy, right? So that is why it is known as, it is also related to aggregate production and national income. So any stabilizers which reduce the GDP fluctuation, GDP means the manufacturing of the product. If those fluctuations are reduced, reduction in the fluctuation definitely shows that the demand and supply are matching somewhere. The personal income tax, corporate tax and transfer payments are prominent automatic stabilizers. How? Let's try to understand with the help of an example. Through these stabilizers, the automatic adjustments are done so as to stimulate the demand during the recession and reduce the demand during the inflation. The stabilization takes place through the automatic adjustments in the government expenditure and taxes. How? Let's try to understand. He says if the people have less of income in hand, or if there is, why there is less of income, sir, that one of the reasons can be unemployment, right? If the economy is underemployed, that means it is not a full employment situation. The people will have less money in hand, right? Reduced income of firms and households and more unemployment. Unemployment is increasing, right? Or people have the less of income, and this was a very common scenario during what? During the COVID times. This was a very, very common scenario that, whatever the salaries you were getting, there were 50 to 60% cut in the salaries. There was unemployment in the economy that was increasing. So what will happen? If the people will be earning less, right? If the people will be earning less, they will have the less of disposable income in hand, obviously. But what are the impacts of the government policy? Sir, if you have less of income, you will be paying the lower taxes. Obviously, you will be paying the lower taxes. That is what? That is due to the policies which are created by the government. There is no deliberate action related to it. It is already a policy which is existent, which is automatically working. Automatically working means there is unemployment, the person is not earning, or the person is earning so less that he doesn't have to pay the taxes, right? Or if there is unemployment, there can be some unemployment compensations which are being provided by the government. During the COVID, this was very common. During the COVID, many people who got unemployed, who were discharged from their duties, the government provided the unemployment compensation in that case. That is a transfer payment, right? That is a transfer payment. The first impact of this is low disposable income, right? low disposable income. Now the government says we need to increase this disposable income so that the people are able to spend money. The economy went into the recession during the COVID. Why the economy went into the recession during this COVID period? The main reason was the earnings were cut out. The people's spending power was very, very less. The people were not demanding anything. Even the basic clothing people were not demanding. People said, whatever we have, that is more than sufficient. And you must have experienced it, right? If you have experienced such a things in your home also, please comment down that, yes, sir, we also experienced the same thing. We were worried about saving the money. Right? What was our focus? There was reduced income levels. Reduced income level means there was low disposable income. Low disposable, now what happened with the low disposable income? The people were to pay the lower taxes. People were getting more transfer payment. What was the purpose? Now, if you are earning, let's say 2 lakh rupees, you are not paying any tax on it, right? And you have the disposable income now of 2 lakh rupees. Right? Now, let's say during the normal scenarios, you are earning 2,50,000. On that, if you have to pay a tax of, let's say, 80,000, what will have? You will have the disposable income of 1,70,000. So the government says these taxes need to be reduced. Right? Lower taxes, lower the income, lower the taxes. And in case of unemployment, they say we will provide you with the transfer payments. This lead to what? This automatically lead to higher disposable income with the firms and households. Right? This also automatically led to the higher disposable income for the firms and households. And the higher disposable income, what is the result of that? Stimulates the aggregate demand, pushing the economy out of recession. Clear? So during that, the government said that we are going to reduce the taxes, or the taxes are planned in such a way that it is automatically reduced, and the reduction in taxes or more transfer payments will lead to higher disposable income. The higher disposable income will lead to the more demand will push the economy out of recession. The exact opposite is in case of inflation. What will happen if the firms and households have the higher income and the more and more employment? The people have lots and lots of money. The people are working, and through their workings, they are getting the very good amount of salaries. Then what will happen, sir? They will have more of disposable income. What will be the first impact? They will have high disposable income. They will have high disposable income. So how the government tries to? High disposable income means they will demand, the aggregate demand will be high. Aggregate demand will be high means the prices will increase, and the increase in prices will lead to inflation. So we need to control the inflation. How will the government try to control this situation? Government will say, if you are having a good income, pay higher taxes. Right? Less transfer payment. There will be no transfer payments. You have unemployment. Why are we going to give you the transfer payment? No, we are not going to give you. This will lead to lower disposable income for firms and households. When you are charging high taxes, people will have less of disposable income because the major part will be paid in the taxes. 30% taxes, 40% taxes. Why are they taxing? Because people should be having that much income that is right for them. Now, lower disposable income means the demand will be controlled. Controlled demand pull inflation. That means you are pulling the demand down, that will pull the inflation down, right? And regulates the consumption. So what you are trying to do in this is you are trying to pull the demand down, right? And in the same time you will be pulling the inflation down. Clear? So this is what is known as automatic stabilizers. That means any factors or any policies which are already there, right? And there is no deliberate action on the part of the government, and those policies or those actions are what they are also the fiscal policies, but they automatically stabilize the economy. They automatically work in such a way that the economy comes out of the recessionary or the inflationary phase, right? And this is how the whole working is. That is known as automatic stabilizers. The next is discretionary fiscal policy. Now, discretionary fiscal policy is when the government is deliberately making some policy for a particular purpose. These are the deliberate policy actions by the government to change the levels and composition of expenditure, taxes, borrowings. So there is a particular, I can say, situation that the government is facing to control that particular situation there is a deliberate action by the government. In that case, that becomes a discretionary fiscal policy. These actions are taken with a view to influence the national output, employment, and the prices. Obviously, sir, right? Actions are to control the output if it is in excess, or to increase the output if it is in shortage. Employment levels, the government is trying to attain the full employment levels, and if it is the unemployment levels are going high, then what is the deliberate action that is required on the part of government? So all those things, and the prices, the government can directly or indirectly influence the level of economic activity in a country. So what is GDP? GDP we have already studied, sir. C plus I plus G. Here this GDP is taking as national income only, right? Leaving behind all the other factors. So we studied about consumption plus investment plus government expenditure plus exports minus the imports. Now he says the government can influence the GDP or the economic activity, that means the production. GDP is what? The production of goods and services within the domestic territory of a country. So he says the government can impact the GDP or indirectly the economic activity by directly controlling the G, that is the government expenditure. Government can reduce the expenditure or government can increase the expenditure. Here what is doing? Here the government is increasing the expenditure, right? So that you can manufacture more goods, you can join more coachings. Your father is doing more expenditure. That expenditure is what? The G part. The G part, the government is trying to control the G part, right? And control the economic activity, or indirectly influencing the consumption, investment, and the exports. For example, government can reduce the taxes and to push the exports, right? The government will say do more of export. The government can reduce the taxes on the investment. Government can provide subsidies for the investment whenever the government wants to push the economic activity. Specific export subsidies and concessions to promote the exports. Now here in case of G, that is the government expenditure, there is a direct control. There is a direct control, but in case of other factors, there is an indirect control through taxes or other policies, right? Government expenditure is, sir, government can directly control whether to do the expenditure or not, simple. But in case of other things, the government will provide the subsidies, or government will charge extra taxes, government will give the concessions, subsidies, right? Or they will increase the taxes, they will reduce the taxes. So all those things are what? They are indirectly controlling the other parts. Clear? So these are the discretionary fiscal policies. That means the deliberate actions on the part of the government to control the economic activity. Here, in case of the automatic stabilizers, we say that these functions, these actions are automatically leading to the stabilization of economy. And here the government is deliberately taking the action to stabilize the economy, right? Through taxes, through borrowings, through expenditure, through any of the fiscal policy measures. Clear? Now, the next topic we'll be doing it in the next lecture, that is the instruments of fiscal policy. Very simple, that what are the various instruments that the government uses as a fiscal policy, right? I have already discussed the taxes, expenditure. So basically there are four. One is taxes, another is government expenditure, another is public debt, and the government expenditure. Now, government budget, sorry, right? So these are the four major tools that are available with the government to control the money for the economic welfare. This is the instruments of fiscal policy. Instruments of fiscal policy are the various tools or the mechanisms through which the fiscal policy can be executed so as to achieve the desired goals, right? So what are the various ways in which the government can implement the policy to get the desired results? That is what is known as instruments of fiscal policy. So there are four instruments: the taxes, government expenditure, public debt, and government budget, which we are going to discuss it in the next lecture, right? And I hope whatever we are studying right now in these lectures, you people have to revise it side by side. That is very important from the examination point of view, guys, right? Whatever we do in one lecture, please revise it the same day, revise it the next morning. It will just take 5 to 10 minutes, nothing more than that, right? But please do revise. And one thing very important, if you are new to the channel and yet not subscribed to it, please subscribe to this and share it with all your friends, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.